Hey everybody, Marty Missouri here. You will receive this video on the morning of Tuesday the 28th of March 2023. It'll be the morning message. It's actually the night before as I record this, Monday the 27th. I was actually putting some stuff together for tomorrow morning's note from our weekly research. And as I was assembling the charts, I thought this would be a good one just to narrate for you on the video. So what I'm going to look at here with you tonight is 7 indicators that are found in our own financial stress index. These would be the independent, I'll call them, indicators. In addition to this, there are 3 or 4 financial stress indexes from different institutions. I want to say 4, Merrill Lynch, Goldman Sachs, and a couple of the Federal Reserve banks. So what I wanted to do is kind of continue to make the case why we think that the risk-reward setup right here for equities, U.S. equities in particular, but I think to a not small degree global equities, is precarious. It doesn't mean that the market is going to come crashing down. It simply means that the risk-reward setup just does not allow us to take on the kind of risk or volatility that we would in a more favorable risk-reward environment. Now, there are a lot of bulls out there. I listened to one this morning on Bloomberg, and he just doesn't see a recession coming, loading up on banks, just very, very sanguine, to put it mildly, about the future with just a tremendous degree of confidence. I like it. I appreciate it. I'm open to it. I just don't necessarily agree with it. Not that he won't be right. It's just that he is really painting a picture that's, in a sense, throwing all caution to the wind, in my view. Not that it wasn't well thought out, but anyway, I want to just kind of show you, this is really zeroed in on clients. I know we have some people who watch these who aren't clients, but just to help you understand why we continue to hedge with put options, why we continue to add to treasuries at the margin, why gold is a pretty big position for us, although as I suggested in yesterday's video, technically gold's not looking so good to us on a short-term basis, but longer term it's something we want to own. It's not a bad hedge, and we think there's a longer-term structural case to be made to own gold, so we want to continue to own it here. So anyway, without further ado, here is the MOVE index. So think of the MOVE as the volatility index, or the VIX as we know it in terms of measuring implied volatility in S&P 500 options. Think of this as the volatility index for Treasury securities, and it can be very telling as it relates to the stock market. So in front of you is a one-year chart. The top is the MOVE index, as it's called. The bottom is the S&P 500. Okay, so you can see that the MOVE index right now is well above 100, and you can see while it's been here over the past year, the market's been very volatile, right? Not devastatingly. The bear market so far, peak to trough, is down like 26%, but it's come off of that since last October. So this would be a reason to be cautious with regard to stocks. And why would that be? Well, let's just run this back to the mid-90s. Okay, so here is the MOVE index. You can see I've already worked on this chart. I think I shared it with you at least once or twice, but here we have shaded areas back across the last 3 recessions. In fact, I can go back in here too. There was some volatility in the mid-90s. But you can see that the MOVE was able to stay above 100 for a while without anything catastrophic. Although here in 1998, that was when Russia defaulted on its sovereign debt. That's when long-term capital management went belly up. And that was intraday, that was a 20% decline in the S&P. On a closing basis, it was just under 20%, so it didn't mark the end of the 90s bull market. But a pretty heralding time in the fourth quarter of 1998. And then you can see the move above 100 here preceded the tech bubble bursting, and then during the whole bursting of the tech bubble, where the S&P was down 50% and the NASDAQ was down nearly 85%, you can see where the MOVE index traded pretty consistently above 100. Calmed down in here, and the market had a really nice run between the two bear markets. And then we got that huge spike in Treasury volatility, and we had the 57% decline in the S&P. Here, coming out of the Great Recession, had a lot of volatility. This was, a 10 or 11% decline here in 2010. This was like 1998, just about 20%. Intraday it was, but didn't close there. This was the 2013. This was the taper tantrum when Bernanke said he was going to start tapering quantitative easing, and that was, it was a double-digit decline. And then in here, we didn't quite get to 100, but we did have a 16% correction in there. And here was a 20% decline, or 19.9 or something in 2018, although we didn't get that big spike in the MOVE index. We did around COVID, and we have it here big time. So we spiked above 100, and we got our bear market. And then, we came down, and we actually got below 100, but we really spiked up there lately. As you can see, we haven't had the commensurate big decline in stocks. So I could just stop the video there and say, folks, with the MOVE index this elevated, reason to be cautious and somewhat guarded with regard to exposure to the U.S. equity market. Let's take a look at the Fed funds rate, the white line there, the upper bound of the Fed funds rate. They have a range. And the 2-year Treasury note yield, right? That's considered an indicator where Fed funds rates are going. But, I could get rid of the Fed funds rate and just take a look at what happens to stocks when we get these big rollover declines in the 2-year yield. So here was the last year, again, stocks coming out of their bear market a bit. And here just recently is the 2-year just plunging below the Fed funds rate. So let's run that one back to the mid-90s. And what do you get? You get that volatility. Here you see it plunge below the Fed funds rate. There's that 20% decline in 98. Here we are plunging, right, ahead of the tech bubble bursting, and then that massive bear market. And, you can see it coming out of it and then plunging again. So that volatility here. Here we are falling out of bed before the big financial crisis. And those other points that I mentioned, right? Here we are, not quite going below, but again, the 2-year plummeting. Here we did go below the Fed funds rate. There's that 20% decline in there. A lot of chop in here. This happened around that 16% decline there. And then we rolled over ahead of COVID, right? And we had the 2018 20% correction, then we had the big one, 35% in 3 weeks during COVID. But again, one signal there was a rapidly declining 2-year yield, particularly when it declines below the Fed funds rate. That's a sign that the economy is in not so good shape. This is a sign that maybe inflation is heating up and the Fed is going to start raising interest rates. So you see here how the 2-year began rising ahead of the Fed funds rate increases. You can see it here. You can see that as well. So there's a reason why we track this thing religiously. So here we had it plunge down below, and there's the beginning of our bear market, right? But then we came out of it. Then we had a 2-year that was ahead of the Fed funds rate. And you see the market kind of stabilizing. Well, folks, that thing has utterly plummeted here. I believe it was the biggest decline in the 2 years since like the 1987 market crash, okay? But the market isn't crashing, as you can see here. It doesn't necessarily mean that. It just says that the risk is there, and therefore don't throw all caution to the wind, like the gentleman who I just used as my example here on Bloomberg this morning. The yield curve. Now, those of you who listen to the financial news and read about investing and finances and economic indicators are probably familiar with the notion that when the yield curve goes inverted, recession follows thereafter. Now, an inverted yield curve is where longer-term yields in treasuries actually drop below shorter-term yields. So what that would suggest is if you're using the 2-year, and this is the 10-year yield curve, and the 2 years going up as the Fed raises interest rates or in anticipation of that, and it goes up faster and higher than the 10-year, you're going to get an inverted yield curve. And an inverted yield curve means that the normal slope, where longer term interest rates are higher, is actually inverted. And below zero means that, in this case, the 10-year is actually lower than the 2-year. And as you can see right here, it's incredibly low. And you'll see when I expand that it's epically low. Well, the history of this says don't freak out right when the yield curve inverts. It's actually when the yield curve begins to re-steepen that you need to start thinking about big declines in the stock market and recessions occurring. So yes, inverted yield curves tend to precede recessions, but a recession tends not to begin until it begins to re-steepen. And you say, well, that's optimistic, right? Well, it depends on the nature of the steepening. If it's steepening not because people are selling the long end because they think that the economy is going to start come bounding back, if it's steepening because people are buying the 2-year treasury and pushing that yield down exceedingly fast, which is what's been happening of late, that's actually negative. That actually says that the Fed is going to start cutting interest rates because we are about to enter what could be a pretty bad recession. Okay, so the immediate re-steepening actually tends to usher in recession. It actually tends to usher in really ugly periods for the stock market again. So here's that 1-year look, and let's expand that back to the mid-90s as well. So there you have an inversion, right? And then a re-steepening. Didn't get a recession that time. We just had a little quick inversion. People say, well, it still preceded the recession, yeah, by a few years. But right around that time, what did you get? You got a 20% decline in the stock market, right? So here you did invert before the early 2000s recession, right? You inverted pretty noticeably. But the recession, the red shaded area, didn't happen until after the re-steepening happened, right? And then you got that massive, massive bear market, particularly in the NASDAQ index. Here you had a quick inversion and re-steepening, right? Again, recession happened a couple years later, but we did get, we got some volatility. We got a correction in there around 2006, and then it re-steepened. Then we had the great financial crisis, which was the worst recession since the Great Depression, and a whopping bear market in stocks. Okay, so I'm not that interested in this up in here, the moving of the yield curve. It's when it goes inverted, signals recession, and then re-steepens. You can see right before COVID. Again, we began hedging back in late summer 2019. Couldn't even spell coronavirus, but it was a precursor to a recession, the quickest one because of the big fiscal and monetary response. But it was still good for a 35% decline in stocks, right? So here, here we have the yield curve coming down, deep, deep, deep inversion, steeper than anything we've seen in modern history. And now we have a massive re-steepening. And, again, doesn't mean this has to happen like it has in the past, but it means that it could. And there's a logical reason why stocks maybe will trade noticeably lower and give us a wonderful opportunity to grab our long-term best ideas at a substantially cheaper price. But nevertheless, it does mean that we should be hedging and very diversified right here, just because of the history of this particular indicator and the ones that I've shown you so far. Okay, how about the high yield spread? So this is the 10-year junk bond yield above and beyond the 10-year treasury. Okay. And I drew a line here at 5%, so the spread is 5% above treasuries for junk bonds. And here's the market, again, the last year. So let's run this one back. Here we are above 5, right around here, this 20% correction, 1998. And here we're staying up here, right, as we meander our way into terrific bear market for the S&P, down 50%. And then, and then the yield curve coming down, and things did well. We want to be owners of junk bonds, by the way, coming out of recessions. We don't want to be owners of them right here. And then moved above 5 right there at the market peak, and right when the economy was barreling into the worst recession since the Great Depression. Moved above 5, 10% correction, moved above 5, 20% correction. Moved above 5, stayed above 5, 16% correction over 2015 and 16. moved above 5, 20% correction in 2018. Moved above 5, 35% bear market. Moved above 5, 20, 25, 26%. Moving above 5, market's hanging in there. Maybe it'll be different than these other times right here, but certainly this added to the other three that I just showed you says, show some restraint right here with regard to the stock market. The Treasury Liquidity Index, okay, this gets squirrely when the pricing of treasuries gets squirrely. Okay, so here's the last year, and you can see we're above, call it 2.26 on the Treasury Liquidity Index. So what does that look like when we go back a few years? Well, we can't go back that far, unfortunately. It looks like 2007 is where I need to recalibrate this. So the index just blew out in 2008. Okay, so that was epic, and of course we know what we got there. Here you can see we came down and bounced off of resistance, and there's where we had our 10% correction. These corrections in here happened without the Treasury liquidity getting too squirrely, except for right here, and that was that 16% decline. And you can see it popped up above there during COVID, right? This is concerning. A Treasury liquidity index that's at these levels says, be careful out there. So this is a senior loan officer survey. Just ran this one out. This is a quarterly graph. But as these lines go up for mid to large firms and small firms, these are lending standards that banks are imposing upon companies that are looking to borrow, right? So this is a tightening of credit conditions when senior loan officers are getting stingy, and you can see that's been going on. And typically when that goes on, once again, it tends to be very bad for the economy, right? These are recessions that followed a substantial tightening in lending standards, right? And then here you have it, of course, with the whole COVID situation. Then it eased off big time with all that money that came in. But I think the next one could be far worse than this, folks, with what's going on in the banking sector. You can see that tighter lending conditions tend to be consistent with recessions, which is our base case going forward, and with real weak periods in stocks. So, the market has come back a little bit, but the senior loan officer survey is saying that capital is going to be real expensive and tough to get, and that is not a good sign for the state of the economy going forward or the state of the equity market. And then last but not least, CDS, credit default swaps. So this is insurance against default, and the top chart here is the average price of CDS for 5-year investment grade. So these are not junk rated companies. And so when CDS gets above 80, it tends to be pretty volatile time. So here's that, that 2011, 2012 period. It's coming down, so that's a positive, but definitely some pretty good volatility in there. And you can see it spiking up here when we had this 16% decline, spiked up here big time when we had that 20% decline, spiked up here hugely when we had that 35% decline. And it's been spiking around, right? You got this right here, right at the peak of the bull market. The bear market so far has bottomed there, but we're moving up again in a somewhat accelerated fashion. Come off the boil a little bit here. But again, folks, just another signal here within our financial stress indicators that says, caution is warranted right here. I'm going to say it for the umpteenth time. I don't know that stocks are going to go down to where we think conditions suggest they should be. Absolutely, conditions could come up and justify these stock valuations, and if so, we'll add to our exposures then. Or equities are going to have to come down to where conditions tell us they should be right now. All things equal, we'll definitely be adding exposure then. Right now, our interpretation is that stocks are holding at levels that underlying conditions don't justify. And that's reason to keep our hedges alive. That's an insurance that we just don't want to be without right now. And then just the overall diversification. We lowered some exposure to some of the more economically sensitive things of late, even things that we love longer term like miners and materials, and picked up more exposures to things like staples and healthcare because they do better historically during recessionary periods, adding longer-term treasuries because they'll do very well in a recessionary period, and actually making our portfolio even a little more conservative as these things continue to develop and these indicators continue to flash to us what they are currently. I can promise you one thing. We will all live long enough to see this all come to an end, and this particular chapter in history will basically play itself out, and conditions will get to where, in the case of equities, where they need to be, or equities will get to where they need to be relative to conditions. And then we have a new scenario to deal with, a new world that we think is going to be different than the old world with regard to how governments approach their economies from a fiscal policy perspective, how monetary policy has to react and evolve over the years to come. Populism is the new ethos going forward. It's a labor-friendly world versus a capital-friendly world that we've experienced the last 40 years. The world's going to make this big shift to renewable energy. All these things actually unearth huge macro investment opportunities beyond whatever this bear market has left in it. So we're really excited about those opportunities. I'm not saying we agree with how the world's going to be or disagree or what have you. I'm not making any kind of a statement there, no political statement, no nothing. Just an observation, like it or not, of the world that we're evolving into, and an understanding of where the opportunities lie, as well as, and maybe more importantly, where the risks lie, what to exploit, what to avoid, and so on, but always within the context of investing consistent with what we think is a good, solid, fundamental view of the current risk-reward setup. Thank you as always for watching and listening. Talk to you again soon. Bye-bye.